Welcome to ABG Finance, where finance and markets align. Today I've just got a quick video on index funds. Now, index funds are going to be different than index or indices. However, index funds are similar to an index or indice in the sense that it is also a measurement or a benchmark of a larger set of related data. However, the index fund, the larger set of data relating to that index fund, is going to be the indice it is tracking. An index fund can be traded. That's a key difference there. An index fund can be traded. Index funds track indices and allow the market an opportunity to trade those indices as underlyings. So an index cannot be traded, and an index fund gives us the opportunity to trade on that index. Index funds, you're going to see, might come with an expense ratio known as the MER. This is a management expense ratio, so typically it comes passively or actively, in the sense that an individual might set up a structured or weighted calculation and let an algorithm passively manage that index fund, or an actual human being, a financial advisor, is going to actively manage that fund. So either way, you might see an expense ratio tied to index funds, and that is going to be why. The two most common types of index funds that you will probably hear are going to be ETFs and mutual funds. I'll briefly get into just a little bit of the difference between the two at the end of this video. So just a market example here of what an index and an index fund will look like or be. On the left, we have our index. Now we know index or indices, these cannot be traded. These are the benchmarks. These are what show us the overall health of the economy, so to speak. As we move over to the right, we can see we have index funds, and these can be traded, and these can be traded via the ETFs or mutual funds, which again are going to be the most probably discussed tradable funds within index funds. So starting on the left with the index example, we have what would be known as the S&P 500 index. So this is a very common US index that tracks, first it's provided by the Standard & Poor's, which is the S&P in this example right here. And the 500 relates to the fact that it tracks the 500 large and competent companies in the US markets. The ticker symbol for this index is going to be INX or SPX, depending on, I believe, if you're looking at the cash or futures chart. Now, moving over to the index fund example, we can see that we still have the same S&P 500, which is the Standard & Poor's 500. So we're still tracking, right? We're still tracking the top 500 US companies, or let's say the 500 large US companies. And we're doing so in an index fund. So the only difference there, right? S&P 500 index, S&P 500 index fund. The other difference, you can see the little up arrows before the ticker symbols. This means that these are not tradable, that these are just index or indices. Whereas on the index fund example, we have our ticker SPY. Now, if you were to look up SPY on your trading platforms, you would be able to actively trade the SPY. And you would do this because the SPY is essentially a calculated, passively active ETF, passively managed ETF, right? So it's got some sort of weighted calculation set to track the S&P 500 index, right? So the S&P 500 index is what shows the health of the economy. The S&P 500 index fund is going to allow us to trade off of the health of the economy. Just a farther example of this. So on the left, we have the purpose of the index, right? That's going to be to track the largest 500 companies listed on stock exchanges in the US. You can see the price value of that index is currently just shy of $4,000. On the right, we have the purpose of the index fund, right? So the index fund is going to be a tradable fund created to track the S&P 500 index as its underlying. So the S&P 500 index fund is not the index. It is our index fund that is tradable and gives us the opportunity to trade the health of the market. The value here you can see is just shy of $400, and this might also kind of give you a visual example as to why these ETFs or mutual funds can be created. Because if you were to simply trade off of our value of the S&P 500 index to the left, the entire basket of goods, that's going to cost a rather large dollar. Now on the right, we have the opportunity to invest in that same basket of goods on a weighted calculation and a much smaller scale that gives us an opportunity to enter that market. So index funds give us a chance to enter markets and trade off index or indices as our underlying. Hopefully I didn't make that too confusing. A more real basic example, and this one kind of relates back to, I think, the beginner example we had in what an index was in the previous video with our company ABC and creating our revenue benchmarks. Now, what I've done here on the left, we have our index or our indices, right? And we can think of these as our basket of goods. So when we go shopping, let's say we get all these products, and each of these products represents a different company. So we have 6 different companies in our basket, and our basket is going to represent our index or our indices. And what happens here, we can see at the bottom, is our index is going to be a weighted calculation of the items in your basket to show the benchmark strength, health, or value of those items as a whole. So this weighted calculation is going to provide us what we saw with the S&P 500 index, which is going to be a large value, right? That was about $4,000, so that's too expensive for us. I mean, it's a great indicator of economic health and maybe the depth of strength, but we simply don't have $4,000 to trade that or be active on trading that. That's where the index funds come along. Excuse me. Now on the right, we have our index fund. So think of it like this. Company ABC comes back around, and what they want to do is they want to provide the market an opportunity to trade off of, let's say, our major grocery index. And so what company ABC does, they release a new grocery ticker called ABCG, a new grocery ETF ticker called ABCG. And essentially what this is going to do is this is going to, let's say, company ABC's acting as a principal here, and they're going to bring an opportunity to the market, right? So they're going to create a smaller, even more calculated and weighted basket of goods that they're then going to compile an inventory on, excuse me, they're going to compile an inventory on of stock, and then they're going to trade that as the ETF ABCG to the market. So company ABC funds an ETF to the market, and that gives investors and traders the ability to place bets and hedges against the larger basket of goods, which is the whole economy. Now, just real brief, the difference between the options we will see in index funds between ETFs and mutual funds. So the first we have, are they tradable? And we're going to see here, yes, they are both tradable. However, ETFs, exchange traded funds, these are going to be tradable all day, whereas mutual funds are typically going to be limited to the end of the day. So access is, greater towards ETFs if tradability is high on your list of priorities. The second, the second is the expense ratio. So that's the MER we talked about earlier. And yes, they are typically both going to have management expense ratios on your exchange traded funds because these are probably more passively or algo driven. These ratios are going to be lower. And on mutual funds, these expense ratios will typically be higher because you've got a professional advisor sitting on the other end of that, managing that mutual fund, whether that's on a daily, weekly, monthly basis. Next, we have liquidity. So this kind of relates back to the are they tradable idea at the top. Yes, they're both going to have liquidity because we know they're both tradable. There's going to be a big difference, though, in volume and that level of liquidity if you can trade all day on the ETF, whereas the mutual fund, we know we are typically limited to the end of the day. So if we're looking for, getting in and out and having that liquidity open to us at all times, mutual funds, very limited. ETFs, highly liquid or greater chance for us to get in and out of a trade or position. With regards to minimums, because this is something that people may not think about, with mutual funds, let's start on this side. Mutual funds, they may not always have a minimum, but if they do, it can be $1,000, $3,000, $5,000. So it's a little bit different if you're just a beginner and looking to kind of get your toes wet. Mutual funds might not be as accessible depending on the capital you're working with, whereas ETFs, right, you can get pretty much. You can buy these on any broker, I believe. Now, I'm Canadian, so for me, this would be something, right, if I'm a beginner, I could open up a Wealthsimple account, and I could essentially be buying ETFs all day, and I don't have any minimums. I could buy one share, or now I believe there's the opportunity to buy even fractional shares of ETFs. So whether you have $1, $5, $100, $10,000, it doesn't matter with ETFs. There are no minimums typically with the ability to access brokers these days. And accessibility, this is kind of tying in the liquidity, tradability, minimums, and the expense ratios, right? So are they accessible? Yes, both are accessible to retail traders and institutional traders. ETFs, I think, are, in my opinion, tailored more towards the demographic of retail traders as a whole because of, right, this group might be individuals who are new to the market or beginners who are looking to just dip their toes in. So if that is the case, they want that ability to use low capital, right? They want a high liquid or high volume market. They want to keep all expenses minimum, and they want to have, depending on whether they work in the morning or afternoon, right, all day having the ability to trade all day gives them the chance to practice. And there are other ways to practice, of course, on market replay data, etc. But anywho, so accessibility, ETFs, yes, I believe they are very accessible to retail. And then the mutual funds, these are also accessible to retail. But you have to, I think, have a little bit more capital or be ready to put a little bit more capital towards a mutual fund in case you get caught on, one of them having a minimum and the expense ratio. These expense ratios are minuscule, right? It's not going to make a big difference right away, but the more money you add, the longer time you hold, those expense ratios obviously add up. So that's a brief breakdown of what index funds are in the sense of ETFs and mutual funds. And obviously there's a lot more in depth we can go, and maybe I'll do that in another video. But I just wanted to follow up with the index indice video and show what an index fund is as well. So I appreciate you stopping by. And as always, keep on keeping on.